Three signals have appeared in the silver market almost at the same time, and when you connect them carefully, the picture becomes very difficult to ignore. Over the past few years, the global silver market has quietly slipped into repeated supply deficits. Industrial demand has climbed to levels we have never seen before. And at the same time, some institutional forecasts are now discussing price ranges that would have sounded completely unrealistic only a few years ago. When you look at these signals individually, they might seem like normal market developments. But when you put them together, something much bigger begins to appear. By the end of this video, you will understand why a growing number of analysts are beginning to talk about a potential path toward $100 silver. What data is actually supporting that idea, and why the broader financial media still seems to be missing several critical pieces of the story. Let's start with the most basic signal in the entire silver market: supply and demand. Because before anyone talks about dramatic price predictions, the first question we should always ask is simple: is the market balanced? According to the latest World Silver Survey published by the Silver Institute, the answer has increasingly been no. The global silver market has been running deficits, meaning demand has exceeded total supply. In 2024 alone, the deficit was estimated at roughly 148 million ounces. And this wasn't an isolated event. Over multiple years, the silver market has repeatedly consumed more metal than was produced through mining and recycling. That means inventories have been doing the heavy lifting to keep the system running. Now this is where the story becomes more interesting, because when people hear the word deficit, they often assume the problem will solve itself quickly. In most commodity markets, higher prices encourage producers to increase output. But silver is unusual. A large portion of global silver production does not come from primary silver mines. Instead, it comes as a byproduct of mining other metals like copper, zinc, and lead. According to the US Geological Survey, only a small number of operations are actually primary silver mines, while many others produce silver incidentally during the extraction of different metals. What that means in practical terms is that silver supply cannot always respond quickly to higher prices. Mining companies are often making decisions based on the economics of entirely different metals. Let me translate that in plain language. Even if silver prices rise dramatically, the global mining industry cannot instantly flood the market with new supply. Many mines simply produce silver as a secondary output, and that creates a situation where the supply side of the market is slower and more rigid than people assume. But supply is only half the story, because at the exact same time supply has struggled to keep up, demand has been accelerating. And one of the biggest drivers behind that demand comes from an area that most people rarely connect to silver: modern technology and energy infrastructure. Industrial demand for silver reached a record level in recent years, with hundreds of millions of ounces consumed in electronics, electrical systems, and solar panels. Solar energy in particular has become one of the fastest growing sources of silver consumption. Photovoltaic cells require silver because of its extremely high electrical conductivity, and despite ongoing efforts to reduce the amount used per panel, the sheer scale of solar expansion continues to push total silver demand higher. Think about what that means for a moment. Silver is not just a precious metal used in coins and bars. It is also a strategic industrial metal embedded in technologies that governments around the world are aggressively expanding. Solar capacity is projected to keep growing through the end of this decade, according to multiple energy agencies. That means industrial buyers are competing for the same metal that investors and collectors also want. Now here's where the narrative begins to shift in an important way. For many years, silver traded in the shadow of gold. Gold received most of the attention as a safe haven asset, while silver was often dismissed as simply a more volatile companion metal. But silver's unique position between the monetary world and the industrial world gives it a completely different dynamic. When economic uncertainty rises, investors buy silver as a store of value. When industrial expansion accelerates, manufacturers also buy silver as a raw material. That means silver demand can increase from two completely different directions at the same time. And when that happens, the price can move much faster than people expect. Now, before we talk about the possibility of $100 silver, we need to address another signal that has been quietly emerging in institutional research. Several large financial institutions have begun discussing significantly higher price ranges for silver in the coming years. For example, research from major banks has suggested that silver could average far higher prices in the next commodity cycle, depending on macroeconomic conditions and industrial demand trends. While forecasts vary widely, the important takeaway is that serious analysts are now openly modeling price levels that would have sounded unrealistic not long ago. And this is where a critical psychological shift begins to happen in markets. At first, higher prices sound absurd. Then they sound unlikely. Eventually, they start to sound possible. And once a price level becomes possible in the minds of investors, the market can move toward it surprisingly quickly. But there is another layer to this story that often receives far less attention, and that is the structure of the silver market itself. Silver is heavily traded on futures exchanges, where contracts represent large quantities of metal. These markets allow investors, producers, and speculators to hedge and trade silver without physically moving bars of metal around the world. In normal conditions, this system works efficiently, but it also means that financial positioning can amplify price movements dramatically when sentiment shifts. If a large number of traders suddenly rush to buy silver futures while physical demand is already strong, prices can move sharply in a short period of time. On the other hand, when traders rapidly liquidate positions or when margin requirements increase, the market can experience sudden drops even if the long-term fundamentals remain unchanged. This is why silver has a reputation for extreme volatility. The metal sits at the intersection of real-world supply chains and fast-moving financial markets. Now here's the point where several of these signals begin to converge. First, the market has experienced repeated supply deficits. Second, industrial demand has reached record levels. Third, supply growth is constrained by the structure of mining production. And fourth, institutional analysts are already discussing significantly higher price ranges. None of these signals alone guarantees a dramatic price surge, but together they form a pattern that is difficult to dismiss. Now let's pause and ask an important question. If all these forces are pushing in the same direction, why hasn't silver already exploded to $100 per ounce? The answer lies in the nature of financial markets. Prices rarely move in straight lines. Instead, they move through cycles of momentum, correction, and consolidation. Even in strong bull markets, prices often pause or pull back before continuing higher. Silver, in particular, has experienced dramatic rallies followed by sharp corrections many times in the past. For example, the metal has previously surged toward $50 per ounce during periods of intense investor demand before falling back when economic conditions shifted or when speculative positions unwound. These historical episodes remind us that silver's journey toward higher prices is rarely smooth. But something different may be developing in the current cycle. Because this time the demand story is not driven only by investor sentiment. Industrial consumption has become a major structural factor. That means demand does not disappear simply because prices fluctuate for a few months. Manufacturers still need silver for electronics, electrical components, and solar technologies regardless of short-term price movements. This is where another interesting statistic enters the conversation. Industrial demand for silver has reached hundreds of millions of ounces annually, representing a huge portion of total global supply. When industrial users consume that much metal every year, even small disruptions in mining production or recycling can create noticeable pressure in the market. And remember, unlike many other commodities, silver production cannot easily expand overnight. Developing a new mine can take years of exploration, permitting, financing, and construction. Even when prices rise, the physical response from the supply side often arrives slowly. This creates a situation where the market can remain tight for extended periods. Now imagine what happens if another factor enters the equation. Suppose global monetary policy shifts toward lower interest rates. Historically, precious metals tend to perform well when real interest rates decline, or when investors become concerned about inflation and currency stability. In that environment, gold often moves first as the primary safe haven asset. But once momentum builds, silver frequently follows with larger percentage gains because the market is smaller and more volatile. This dynamic has appeared repeatedly in past precious metal cycles. Gold begins attracting attention as a hedge against economic uncertainty. Then, silver begins to accelerate as investors look for assets that could potentially move faster. When that transition occurs, price movements can become dramatic, and this is why the concept of $100 silver has returned to serious discussion. It is not because analysts believe the number itself is magical. It is because the underlying forces that drive silver markets appear to be aligning in unusual ways. We have a metal that functions both as an industrial input and as a monetary hedge. We have supply growth that cannot expand quickly. We have industrial demand connected to rapidly growing technologies like solar energy. And we have a financial market structure capable of amplifying price moves once momentum begins. When those forces combine, even conservative analysts start paying attention. But here's the most important takeaway. Predicting the exact price of any commodity is extremely difficult. Markets are influenced by countless variables, including global economic growth, interest rates, currency movements, geopolitical tensions, and technological changes. No analyst can guarantee that silver will reach $100 per ounce within a specific time frame. What we can do instead is analyze probabilities. And the probability of higher silver prices increases when multiple independent signals begin pointing in the same direction. That is exactly what we are seeing today. Supply deficits are tightening the physical market. Industrial demand continues to expand. Institutional forecasts are adjusting to higher price ranges. And the macroeconomic environment remains uncertain enough to support interest in hard assets. Individually, these factors might not seem dramatic, but together they create a narrative that is difficult to ignore. And this is why more investors are beginning to watch the silver market closely, because sometimes the most important developments in financial markets are not the headlines everyone is talking about. They are the patterns quietly forming underneath the surface. So the real question now becomes simple. If these trends continue, supply constraints, industrial demand growth, and macroeconomic uncertainty, where does the silver market go next? Do prices stabilize at higher levels? Do they experience another powerful rally? Or does the market eventually test levels that once seemed impossible? That is the question investors around the world are starting to ask, and it's exactly why we keep tracking these signals every day here on Safe Haven Metals. But now I want to hear from you. Do you think silver could eventually reach $100 per ounce during this cycle? Or do you believe the market will face another major correction before moving higher? Let me know your thoughts in the comments. And if you enjoy breaking down real financial signals and connecting the macro trends shaping precious metals and global markets, make sure you subscribe so you don't miss the next analysis.